discuss the GRA, fiscal policy, and general tax administration. Okay. Then when we finish that, we'll move on straight to part B, which is personal income tax, where we'll discuss employment taxation. We'll discuss taxation of business income within the individual context, and then partnership taxation. And again, we'll talk about capital allowance, corporate income tax, realization of assets and liabilities, VAT, withholding tax administration. For our part B is most loaded. And then when we are able to do that, finally we'll finish with tax administration. So that will be our plan, and we'll see if we can use between 5 to 6 hours to finish this. We'll be having short breaks, about 2 or so, if necessary. So let's begin some work here. Before we move in, all of us do have some understanding of tax. It's important we get that so that at least we know how we progress. How many of us are sitting in a tax class for the first time? At least all of us have some understanding of how tax works, so that makes it easy for us. All right. Now, let's move in to look at the residency of a taxpayer. Or when we say residence, what does it mean in tax? So we are going to look at resident individual. When we say resident individual, what it means. When we say resident company, and when we say a resident partnership, what does it mean? Resident individual, the first definition of a resident individual is someone who is a citizen. First definition of the person is a citizen, and then that person has not traveled outside of the country for a period of more than 365 days. That's a resident. And then someone who is an employee of the government posted abroad. That's another definition of a resident individual. And then lastly, a non-resident person who has stayed within the jurisdiction for at least 183 days continuous. So these are the categories of resident persons for tax purposes. And when we go on, you will understand why it's important to understand whether someone is resident or non-resident. So again, to recap, when we say a resident individual, first definition is that that person is a citizen. Number two, that person is a citizen who has not traveled outside Ghana or has not stayed outside of the country for more than 365 days. Number three, that another citizen who is an employee of the government of Ghana posted abroad. Those who work for the foreign missions, the embassies across the world. If the government of Ghana has posted you as an employee, you are resident for tax purposes, regardless of the number of years you spend in that country. Once you are an employee of the government, you are resident for tax purposes. And then the other one is a non-resident person who has stayed in the jurisdiction cumulatively for how many days? 183 days. Okay, so when we say a resident individual for tax purposes, that's the definition. Number two, when we say a resident company, what is a resident company? A resident company is a company that has been incorporated under the Companies Act. You understand? Under the Companies Law. At first, we used to quote the previous Companies Act. Now it's been changed. So a definition of a resident company is a company that has been incorporated under the Companies Act of Ghana. It does not matter whether the owners are resident or not. Once the company has been registered or incorporated here, it's a resident company for tax purposes. I hope that is clear. And what is a resident partnership? A resident partnership, the definition says any partner where at least one partner resides in Ghana for the year of assessment, is resident for tax purposes. So all you need is that at least one partner should have resided. The law didn't tell us for how long. And so once we have information to suggest that at least one partner has resided in Ghana for the year of assessment, it means that the partnership is resident for tax purposes. Okay, and then another group of taxpayer is a Ghanaian permanent establishment. A Ghanaian permanent establishment. So, what is a permanent establishment? It says permanent is treated as a resident company. So, permanent establishment is a business enterprise, a physical business enterprise owned by foreign individuals or foreign persons. So, any person who is not a Ghanaian, they don't reside here, but they own a business here. That business is not registered under our laws. It's operating here just like a company, but it's not been registered here, and the owners are not here. We call that kind of business a permanent establishment. So a Ghanaian permanent establishment is also treated as what? A resident entity for tax purposes. Please, do you understand? So a Ghanaian permanent establishment is also treated as what? A resident entity for tax purposes. Any other definition which is opposite to what we have outlined is a definition for a non-resident person. So apart from the things we said right now that are the definition of residents for entities or individuals here, if it is not what we said, then it's a non-resident person. All right, any question before we move? Any questions? All right, so that is that. Quickly, we move on to the forms of taxation. And because I am assuming we have done a lot here, I think it's safe to go a bit fast. So let's talk about the forms of taxation. Forms of taxation. So when we say forms of taxation, we are basically talking about direct and indirect. Direct and indirect. In Ghana, taxes are classified mainly into two broad groups, direct or indirect. The direct taxes are the ones where the burden of the tax or the person who the tax is levied on cannot transfer it to another person. That person will be the one to pay. It's not possible for that person to transfer the tax burden or the tax liability. Examples are the PAYE, pay as you earn, or employment income tax, gift tax, the corporate or the company income tax, etc. These are examples of direct form of tax. Indirect is where the burden or the incidence of tax can be transferred, as long as there is a chain where there's production and distribution. So along the production and distribution chain, as long as you can transfer the burden of the tax, we call it indirect tax. Examples are VAT, the levies, all the levies, the National Health Insurance levy, the Get Fund levy, the CST, Communication Services Tax, etc. All these are examples of indirect tax. Why? We say you can transfer the burden of the tax from one person to the other. So, for instance, if I am a distributor or I am a wholesaler, I buy from a manufacturer charges me VAT. That VAT will be part of the amount I paid to the manufacturer. Now I have the opportunity to resell to the next person in the chain. I'll also include the VAT and make sure it's part of my bill or my invoice to the next person. So what have I done? I succeeded in transferring the tax, the VAT, to the next person. He transfers to the next person until the final consumer gets to pay the tax. That is why we call it indirect taxes. Okay. So, what are some of the benefits? They may ask you what are some of the benefits of direct tax. Much as possible, we can contribute and let the class be lively. So, why do you think maybe a direct tax is, has some benefits or some advantages? It's easy to collect. True. Direct tax is easy to collect. So that's an advantage to the government. It's easy for government to collect. All right, because if the number of people is 1,000 and then you impose a tax, all of them are employed, all you need to do is to tax the employers. Before you pay them, take the tax. And that's easy. Companies, once your existence is known, you are trading, it's not difficult for government to assess you and collect the taxes. All right, so that is correct. It's consistent. It's consistent. All right, it's consistent. It's easy to follow some consistent pattern. You always, the way we calculate employment income tax, corporate income tax, there's some consistency in it, and it's easy. Apart from that, we can also talk about the yield. So there's always a higher yield if the population grows, because it's easy to collect, easily assess the taxpayers and levy the tax on them. So when the population is growing, direct taxes are more likely to also grow. All right. What do you think are some of the downsides of direct taxation? They might ask you just for discussion purposes. Are there some downsides? They can serve as a disincentive to work. Because yes, the more work you do, the more taxes you pay. So if you may want to reconsider if the tax rates are so high, income tax rates are becoming so high, people might decide that, well, I have to advise because I think I'm paying too much taxes. So it could be a disincentive to work. All right. And then so many others. How about indirect taxes? Which one is difficult to evade? Of the direct and indirect, which one is more difficult to evade? Direct or indirect? The direct, the indirect. Which one is more difficult to evade? To evade. Indirect. To evade. To evade. Which one is more difficult to evade? Indirect. The indirect people have won. Okay. Okay, so it is possible you may be doing some work right now, all right, in any income, and you may not comply. Do you understand? It's possible. You can have a business right now, and you have not disclosed that business income. It will not be taxed, or it may not be taxed. But as long as you buy products and consume, you will pay the indirect taxes. Are you getting it? Unless you decide not to consume, not to buy anything. Even if you decide not to buy anything, you will buy trotro, you will pay the tax. Yes, that's it. Unfortunately, that is the truth. So, the indirect taxes are more difficult to evade. So, you think around these things. If they ask you to explain the pros and the cons, the benefits and whatever about the two, you can always navigate it. So, let's now talk about classification. Another classification of taxes. So, taxes are generally classified as progressive. Classification of taxes: progressive, proportional, or regressive. So taxes can also be classified either as progressive taxes, proportional taxes, or regressive taxes. So when we say progressive, it means that as the person's income tax, the taxpayer's income grows, his tax, liability also grows. So when your income increases, the amount of tax you pay increases. All right, or the ratio increases as your income grows. So it means if the ratio of tax to income is say 20% now, as your income increases, the ratio may be increasing. That's what it means. So the ratio is not the same. So possibly the tax is increasing higher than the increase in the income. That makes it progressive. Are you getting it? So income increases, tax increases, no problem. But if the ratio is increasing as the income is increasing, then that form of tax is progressive. A typical example is the pay as you earn. And so when you look at the graduated rate, the first 319 is 0, the next, whatever, give me the amount. It's 5%, the next this amount is, do you understand? That, and when your income increases beyond the 20,000 mark, you pay how much? 30%. So that tells you that when your income, much of it is in that bracket, in the last bracket, you pay more taxes. So when your income is growing, the ratio of tax to income increases. That is progressive. How about proportional? How about proportional? Proportional means that, how about proportional? That everybody is paying the same percentage of their income in taxes. Do you understand? So it's not progressive. Let's say, let's look at a good example, proportional taxes. A good example could be, let's say, gift tax. All of us are paying the same rate. The bigger your gift, the higher the tax you pay. But the rate, the percentage rate is the same. Do you understand? So that's a proportional tax. The gift tax is an example of proportional tax. The ratio of the tax to income is the same. Everybody pays the same rate of their income in taxes. That is an example of proportional tax. The last one is regressive taxes. Regressive taxes are the direct opposite of progressive. Okay? So as your income increases, the rate of tax you pay is decreasing. All right? So it benefits the rich people. The rich people gain and the poor people suffer. So example is almost all the indirect taxes are examples. So a higher percentage of the poor man's income is spent on the tax. A smaller percentage of the rich man's income is spent on the tax. That makes regressive. So it's the percentage of the taxpayer's income which is paid in tax is what we are considering here. All right. So relative to your income, as the income grows, the ratio of tax is decreasing. You get it? And we are saying that all the indirect taxes, VAT, the levies, the duties, all of them are examples of regressive form of taxation. Any questions? As much as possible, let's make it interactive. Otherwise, you doze off. So let's make it interactive, please. Let's look at the characteristics of a good tax system, right? Or what we call the canons of taxation. According to Adam Smith, who is the one who came out with our first set of what characteristics we should see before we say that a tax system is good. Others have also come up with a few others. But let's just look at this. So essentially we are saying that for you to say a tax system is good, there should be equity. There should be equity. So there should be equity. When we say equity, equity means fairness, right? Yeah, the system should be fair. It should be fair to all the taxpayers. It should be fair to everyone. So if we are all earning the same amount of income, then we should be expected to pay the same amount of tax. All right? If others are earning more than others, then those who are earning more should pay more taxes than those who are earning less. That is equity. You can have equity vertically or horizontally. Vertically means that those who are earning higher should pay higher compared to those who are earning lower. Horizontal equity means that if we are all on the same level of income, then we should be expected to pay the same or similar amount of tax, if not the same. So if the tax system is not guaranteeing this, then we say there is no equity. All right. The second one is there should be certainty. There should be some certainty in the computation, the calculation, and everything of taxes. There should be certainty. It should be easy for the taxpayer to easily determine his own tax liability and pay. It shouldn't be so difficult to understand how the tax system is working, how you can determine the liability, and all of that. Number 3, there should be convenience. There should be convenience. Convenience means what? People should be able to access the tax offices and pay with ease. Now, they've introduced online filing of taxes. So that is an example of an approach to ensure convenience. So in the comfort of your room, you can file your income taxes and then keep the receipt somewhere in a folder to prove that you have filed the taxes. So that's an example of an approach or a policy to ensure there's convenience. Economy. Economy means that the benefits to be derived or the amount of taxes government intends to collect, okay, the cost incurred in collecting those amounts should not exceed the tax benefits. So if it's so difficult, so expensive for government to mobilize and collect a particular type of tax, it makes no economic sense to want to, implement that type of tax. Example is the gift tax. So many people get a lot of gift, but they don't disclose, they don't pay. If government wants to enforce that law, how? Is government going to, put officials into cars? They should be moving across the country and be monitoring people who have gifts and make sure they pay taxes. It will be difficult, you understand? Okay, so there should be productivity. Productivity means that, the tax system should be able to generate a lot of revenue. It should be easy for people to comply. You understand? Government should be able to generate a lot of revenue from that particular type of tax. So, and then elasticity. Another example is elasticity. Those who have done some form of economics. When we say elasticity, what does it mean? That, for instance, increase in the rate of tax should not change it. It shouldn't change the total amount that is collected very much. In other words, we always use the example of salt. If they increase the price of salt, the amount of salt that will be consumed will be the same amount. Do you understand? That's the example they use then to teach us elasticity. That whether the price goes up or not, you simply don't have a choice. You will buy the salt. So that's the term we are using here. Elasticity means that even if the tax rate is increased, the amount government will collect will not be impacted significantly. All right. So that is that. And then flexibility. Flexibility means that it should be easy for the system to be changed. If there are suggestions for improvement, is it easy for the system to be improved? Can the policymakers do changes in the tax system? Is the system designed such that it can accommodate those changes? That is flexibility. All right. So these are a few discussions we want to have on the issue of the tax system. Any questions? Okay. We are fine. Now we want to talk about the income types which are mostly subject to tax in Ghana. Income. So we are coming to talk about income tax here. All right. Income tax. All right. Most of our discussions will be on income tax. In fact, it's the bigger of the issues. So, what type of income is subject to tax in Ghana? Please let the class be. I'll be calling names. What type of income is subject to tax? Employment, business, investment. All right. So income from these three main sources is what is accessible for a year. All right. So income which is liable to tax. All right. So now let's start by saying that we first of all talk about resident person, non-resident person. How is this important for income taxation? We are saying that resident persons are taxed on their worldwide income. Very important. If you are a resident person, income you earn in Ghana will be subject to tax. If you earn that income outside of Ghana, it will still be subject to tax in Ghana. Why? Because you are a resident person. That is the tax system we operate. So once you are a resident, you earn some money in Ghana, you earn some from South Africa, Nigeria, they will all be brought together and taxed. You understand? But a non-resident person pays tax on their income. What type of income? If that income is derived from Ghana. So a non-resident person may not be taxed if the income in his hands is not generated from Ghana. So that's the difference. So resident person is taxed on all of their income, whether generated here or elsewhere. But non-resident person, your income is only taxed if that income is generated from Ghana. So if that income, non-resident person, that income is sourced or generated from elsewhere, outside the Ghanaian jurisdiction, that will not be taxed here in Ghana. That's a general principle, all right? Now let's look at what a chargeable income is. We said that chargeable income for a year of assessment is the total of the assessable income of the person from each employment, business, or investment. So when we are determining the chargeable income of a person, you have to look at all these three sources, okay? So in your computation, you will make sure you put all the sources together. You will do it, you will determine the employment separately, determine business separately, investment separately, but all of them is in one computation. So we said that the chargeable income of a person for a year of assessment is that person's income from all the investment, employment, or in business. The chargeable income of a person of a year of assessment is the total of the assessable income of that person from each employment, each business, and each investment. The assessable income is made up of income from business, investment, and employment. Alright, when we say business income, what do we mean? Service fees. When you are in business, how do you generate your income? Your business income will include what? Income from a trade, profession, vocation, isolated arrangement of a business character. So income from business is more likely to be, if you are in a retail business, your consideration from the sale of your trading stock, all right? Or maybe any gain you have made from the realization of assets, depreciable assets. Those are examples of, income from business. Investment income includes gain on realization of investment assets, gift received in respect of the investment, lottery, consideration for accepting restriction to conduct investment. All we are saying is that whether business or business investment, what is the nature of income that will be taxed? If it is investment, your gains from that business. If investment, the gains, maybe if a stock exchange, whatever, shares, have you made some gains? If you just simply bought shares, you don't start, paying taxes. We need to know that you have made some gains. How do you make the gains? You would have sold some of the shares. So we'll calculate capital gain and ask you to pay tax. You understand? If it is business, you would have made some sales to customers. You would have, possibly made other income by depositing some money and other, all those will become business income. Or you have sold some of your assets and you've made some gains on the realization of those assets. These are all examples of income from each source. And then what are your income? And now this one, I want the class to contribute. When we say employment, what are some of the examples of income from employment? Salary. How can you forget salary? Salary, bonus, allowance, overtime payment, commission, gift. The list is very long, very, very tall. Do you understand? So these are some of the things The income, so when we say chargeable income, the class we understand. The chargeable income of a taxpayer for the year is the person's income from each business, each employment, each investment. All right. Now, we looked at examples of those sources. Let's look at what type of income is not taxable. What type of income should not be taxed? Section 7 of the Act 896, the Income Tax Act, talks about, gives us a long list of exemptions. Say the income of the president is gratuity, allowances, bonus, everything is not taxable. So the president is always the first person. He does not pay tax. So salaries, allowances, gratuities of the president, income of a local authority. A local authority, the district assemblies, municipal assemblies, electoral commission, those are local authorities. Local authority income is not subject to tax. Only if the income in question is connected to the status of that particular local authority. What that means is that is the income connected to what they are doing, what they are set up? The EC, what kind of income will the EC generate? If the EC, the yellow income the EC will get is the subvention from government. What the government gives the EC, that will be the income. That income cannot be taxed. Let's assume the EC decides to acquire properties across the country and is renting those properties. The income from that, will it be subject to tax? Under the current principles, yes. Unless another act of parliament says that every income of the EC, whether connected to their status as EC or from other sources, should not be subject to, unless that is the case. Other than that, any income from other sources which is not connected to their sources may become taxable. But the general principle is that local authorities, income for local authorities is not subject to tax. Say again. The filing fee that who pay? Yes, it's still very much part of their work as a commission. It's very much connected to what they are set up to do, so it will not be subject to tax. I hope you understand. But that's a good point. Okay. You can also talk about income of a public corporation which is not set up as a commercial venture. So there are some entities that are considered to be public corporation. Can you give me examples? Public corporations. Oh, a lot of them. Say again. The housing. Okay. The housing. How do you call it? How about the GNPC? State Housing. Yes, State Housing Corporation. So, yes, that's why they said if it is not set up as a commercial venture, so it is possible you could have some state enterprises that are not set up as what? Commercial venture. So if you can find some, that's why I'm asking the question. So the state housing, I'm sure they are not set up as commercial. GBC, yes. GBC, is it a local authority or is, well, we can debate that. The income of a cocoa farmer is also not subject to tax. The income of a cocoa farmer is not subject. So the cocoa farmer, the income the cocoa farmer gets from the cocoa business is not subject to tax. The pensions, adjunct pensions is not subject to tax. Say again. All pensions subject to the provisions of the Pensions Act, Act 766. Subject. So there are certain provisions that if you want to make withdrawal from your pension fund and all of that before a certain time, it will be subject to tax. So we say subject to provisions of the Pensions Act. All right? But the general principle is that pensions are not subject to it. So if you grow old, you've been paying your SNIT and then PF. When you are 60, you say you've gone on retirement. Then they'll be giving you something small every month. They will not tax it. That's all. So your contribution to the fund is tax-free. Your withdrawals from the fund is also tax-free. If you have done all the withdrawals and the contributions, within the limits provided in the law, then pension is not taxable. All right. Another example is the income of an individual from employment in the public service of government of a foreign country. All right. So someone who is an employee, for instance, of the American embassy, the salary paid to such a person may not be taxed in Ghana. All right, under certain conditions. One, if the individual is either a non-resident person or is a resident person only by performing that employment. If the person could be either a Ghanaian resident or it could be a non-resident person, but he is in the country to solely do that job. So the individual is either a non-resident or is a resident in the country solely by reason of performing that employment. If that condition is the case, the person's income will not be taxed. 2, the individual does not carry any other employment or carry any other business in the country, and the income is payable from the public funds of that foreign country. And lastly, the income is subject to tax in that foreign country. So if these 4 conditions are there, anybody who is in the employment of a foreign mission, or how do you call it? We say the public service of the government of a foreign country is the same as the embassies, the foreign commissions. So those employees don't pay tax. The reason is what we have said here, that they are here in Ghana only for purposes of exercising that employment. Their income, which is paid to them, is subject to tax in that other country where they are coming from. It is that foreign country that actually pays them. Are you with me? If all these conditions are there, then their income will not be taxed in Ghana. The same courtesies are also accorded to our friends, our fellow Ghanaians who are there. So it's a diplomatic kind of arrangement. So do you understand? There are a number of times that the CA asks questions around this. They ask you to list out the conditions under which someone who is working for a foreign country here in Ghana may not pay taxes. Yes, someone has a question. Ghanaians who are employed by American embassy, they will pay tax. They will pay tax. They earn that income here as citizens. Remember, we said that if you're a citizen, all your income, worldwide income, will be taxed here. The only reason someone working with American embassy will not pay tax here is the reasons we listed. That the person is here for purposes of doing or exercising the employment. So it means they are not citizens in the first place. They are here to do that job. Number 2, they don't do any other employment or business. 3, their income is paid from, say in the case of American embassy, their income is paid from the American, government. And that income is taxable there. It's subject to tax there in America. So if those conditions are in place, that person's income is not subject to tax. Okay. Having said that, we want to quickly move on to a few discussions around the entity or the organization that has the mandate to run taxes in Ghana, the GRA. Someone has a question? We'll talk briefly about the GRA and then we can move on quickly to fiscal policy. Let's see how fast we can do with this. All right. So what is there to know about the Ghana Revenue Authority? We should know the mandate of the authority. We should know the mandate maybe of the Commissioner General. Okay, so the authority we know today as the GRA was not GRA. Before 2009, it was not GRA. It existed as what? IRS, Internal Revenue Service. And then another is what? VAT service. And another is what? the SEPS, Customs, Excise, and Preventive Service. They are 3 revenue collection agencies that are autonomous. They are on their own. Then in 2009, they were brought together under one umbrella. And then we call them what? The Ghana Revenue Authority. So why would we do that? Are there some objectives for trying to merge the revenue collection agencies? They can ask you. And do you think that we have made some benefit from merging them? So these are some of the administrative questions that may come. I think last sitting or two, there were questions about the role of the board of the GRA. Other times you can see the role or the functions of the Commissioner General. So just make sure you spend some time to go over it. Essentially, what is the structure? The structure of the GRA is that it's kind of segmented. So we have the GRA divided into 3 different segments now. We have what we call the Domestic Tax Revenue Division, DTRD. Then we have the Customs Division. Then we have the Support Services Division. 3 main divisions. That's the structure. And then on top of this, we have the Commissioner General, who also reports to the board. Do you understand? You know, who is currently the board chairman? Is Prof. Adai still the chairman? So the Commissioner General reports to the board of the GRA, a 9-member board. Most of the members are appointed by the government, including the commissioner and the board chairman. And then there are 3 units of the GRA. Most of the taxation issues happen here, both direct and indirect, as long as it's direct taxation issue is handled. But you know, when it comes to customs, the duties, you know, customs duties, excise duties, those things are handled by the customs division. The support services are those audit people, IT, and all the other tax education and stuff that is happening. They are in charge of it. So this is the structure of the GRA. Each of the units is headed by a commissioner and then assisted by deputy commissioners. Again, the structure they have to do segmentation based on the size of taxpayers. All taxpayers are grouped into segments. So you can have the large taxpayer, you can have the small taxpayer. Now we don't call them taxpayer office or unit, we call them what? Tax Services Center. Taxpayer Services Center, TSC. Apart from the LTO, which they still call large taxpayer units. The rest, medium, the small, they call them what? So medium taxpayer services center or small taxpayer services center. Essentially what we are saying is that we will have the large taxpayer unit, large taxpayer unit or office, what we call the LTO. Then you have the medium TSC. Then you have the small TSE. I have seen questions where students were asked to explain if there are any benefits associated with this segmentation. All right. So what do you think would be some of the benefits for segmenting the structures of the authority in order to deal with or to serve taxpayers in clusters? So they can meet their needs. We will be able to identify the specific needs of each taxpayer group and address them. It will be easy for them to carry out tax education because not all the taxpayers need the same level of education. You understand? So it will be necessary for this segmentation to happen. It will be necessary to ensure that there's higher compliance if we can segment taxpayers like this, and so many other reasons. Okay, it will also help us enhance revenue mobilization Now let's look at what the objectives of the authority is. To provide a holistic approach to tax and customs administration. Holistic. Holistic means that everything is done as a whole, in all its forms. Everything is handled by the GRA. The whole idea is that now we are doing digitization, that it should be possible that whatever request you have from end to end, from maybe direct taxes, indirect taxes, to customs, to registration for TIN and all of that, you can do them under the same roof. So to reduce administrative and tax compliance costs, we are talking about the objectives of the authority. To promote efficient collection of taxes. All right? To ensure greater accountability to government. How do we ensure that? Now, you are not supposed to send money to the GRA offices. All right? It's all part of, higher accountability to government. And all the portless, the cashless port, right? The cashless port is to ensure that leakages are reduced to the barest minimum. And I think, by and large, it has worked. And as for the thieves, they will always find their way. And that one, you can't do anything about it. But we need to reduce. Sometimes they intentionally put frustrations in your way so that you yourself can reason up. You understand? To improve information linkage. All these are the objectives of the authority. To provide common tax procedures, provide one-stop service for taxpayers, among others. Any questions? You can have, when you check the GRA note we shared, I think as part of the tax administration, there are other functions of the board and the commissioner general and all of that. So those ones, at your own spare time, just read over them. Don't waste time on those things. It's a matter of getting an idea. There are bigger issues to concentrate on. Please, is it clear? Any questions? Any questions? Okay, so all this we are talking about now usually are bits and pieces that they put together, and sometimes up to a maximum of 20 marks. So the role of taxation, benefits of taxation, the GRA, and some small administrative issues, fiscal policy, government revenue generation, and all of that. So that is where we are. And I want you to follow. When you get the chance at home, just go over it. The reason why I always start here is that if you are not careful, you'll be chasing the understanding of how to determine tax liability, how to calculate everything, and then you'll be losing vital marks. And it's very important. Where you think you are technically sound, you are not the one who is going to put together a marking scheme. It's good to want to understand everything. But there are marks you can easily get to enhance your chances of crossing 50. Do you understand? So please, don't be like me. When you want to start learning, learn the introduction bit first and get a better understanding of how the course is, or know something about the course. That is why I always want you to appreciate this beginning part, this introduction part. Having said that, what is fiscal policy? This one, I can't even remember any time that it never came. It always comes. So, what is it? Here too, I want the class to talk. Otherwise, you doze. Fiscal policy, we've said it over and over. What is it? Say again. Yeah. Tax policy, fiscal policy, okay. Fiscal means what? The term fiscal has got something to do with what? The budget. The budget. Fiscal means, fiscal I think is a Greek word which means budget. So everything fiscal has got something to do with what? Government's budget. What is inside government's budget? Revenue and expenditure. There are only two things. All the other terms and nomenclature, everything is reduced to two items: revenue and expenditure. Out of the revenue and expenditure which is in the budget, we also talk about deficit financing. Then subsequently, we have issues like what? Debt management. Because why do we borrow? We borrow because we are not able to generate enough money to support our expenditure. Are you with me? That is the costing. So when we say fiscal policy, we said that it is government use of revenue. When we say revenue, we mean tax. Government use of tax revenue and what? Expenditure policy to determine the direction of the economy or to determine how the economy performs. Are you with me? So fiscal policy is the use of what? Tax revenue. The government's use of tax revenue and expenditure policies to determine how the economy is run. Okay, so and here too, I want the class to contribute. The means by which government can influence macroeconomic productivity levels by increasing or decreasing tax levels and public spending. So, two things. Increasing or decreasing tax rate or public spending. There are two things. So, the finance ministry or the finance minister has two main things to do. How does he use, tax revenue policies to achieve that? Or how does he use expenditure policies to achieve that? All of what he does can be christened as fiscal policy. His administration, he determines a lot of the things, whether our lives are comfortable economically or not, is in charge. Do you understand? So you can use tax revenue or what? Expenditure to determine how the economy performs. You can use this combination to achieve growth, okay, or to contain the growth. Sometimes growth is too much. So the problems that come with excessive growth is serious levels of inflation. So government can decide that where we have grown up to, our level of growth is enough. Beyond this point, we will suffer. So let's contain the growth. Government can still use tax revenue and expenditure policy to achieve that. All right? So we are going to look at the various types of fiscal policy and how government can implement them. Any question? Before that, what are the objectives of fiscal policy? The objectives of fiscal policy. What are the objectives of fiscal policy? Now, we've explained already what fiscal policy is, and we said that it is government use of tax revenue and what? Expenditure. To determine how the economy grows or how the system is run economically. And so we are saying that it all boils down to two things: tax revenue and expenditure. So what are the objectives of fiscal policy? One, full employment. When we say full employment, it means that practically everybody or almost everybody who is capable of working should have work to do. Everybody or nearly everybody who is ready and capable to work is able to work or has work to do. That is full employment. It means that job is there for everyone. We don't have that situation anywhere in the world. But other countries, their unemployment rate is low compared to Africa. So full employment is one of the objectives of what? Fiscal policy. So how do we use tax revenue and expenditure to achieve full employment? You should always think around that. Okay. Price stability. Price stability. How do you stabilize prices? Through the use of tax revenue and expenditure. Here, I want someone to help us. Can you stabilize prices through the use of tax revenue? Yes. So you see fuel price right now. How can you do that? Just remove some of the levies from the petroleum product. You will be able to stabilize it. Do you understand? So it's a clear example of a use of what? Fiscal policy to stabilize prices. Again, you can also use expenditure. Okay? You can also use expenditure. How? You can subsidize some of the inputs for, let's say, the oil producing companies or the OMCs, whatever. Do they need help so that at least government can tell them you cannot increase your prices for, say, a year, or government can put conditions that you cannot increase your price. Another example is that you know that the producer price of cocoa is set by government. You know that. Why is government able to do that? Because government is the one that subsidizes their input costs, their fertilizers. Sometimes it's distributed to them free of charge. And so government, by subsidizing the input cost of farmers, can influence the pricing. So government can achieve price stability through the use of fiscal policy. You can accelerate the rate of economic growth. How? How do you accelerate the rate of economic growth? So what these things you need sometimes to think of how to elaborate or explain them. Because these things mostly can come for 10 marks. You cannot list the points like this and get a 10. You should be able to explain. To accelerate economic growth through the use of fiscal policy. How do you do that? If you want the system to grow, it means that you want businesses to do well. So the people's purchasing power is high. The household's purchasing power is high, or their disposable income is high. So they can buy more goods and services. How will that happen? You need to reduce taxes. You understand? So if you reduce taxes, people's disposable income will be high. Then they can patronize more goods and services. So you can achieve a growth objective through the use of fiscal policy. The same is what we call expansionary fiscal policy. We'll look at those quickly. Optimum allocation of resources, equitable distribution of income and wealth, economic stability, capital formation and growth, and all that are examples of objectives of fiscal policy. Objectives of fiscal policy. Other times they ask you, what are the objectives of government spending? What does government spend? For similar reasons. For employment. To ensure there's economic growth. Alright? To expand the productive sector. Among other reasons. Are the reasons why government will spend money. Do you understand? Okay, so who can give me examples of key government expenditures as part of the growth agenda? Roads, good. Good. Yes. Say again. Public schools, okay. Agenda 111, okay. Hospitals. Yes. How about 1D, 1F? Those are growth. You see, that it's because of the system we are running. People, when one person, the leader stands and comes out with a policy, everybody will make noise, yeah, but we are not committed. So at the end of the day, the thing just remains at the idea stage. But if you read around these objectives, 1D, 1F, and there's another one. There's another one. No, the one that they produce is under agric. Planting for food and jobs. Planting, perfect idea. But implementation has always been a problem. Perfect idea. Anyway, I always advise my friends that when you go to parliament and then upwards, make sure you don't disappoint us. Let's move on. Now, let's look at examples of fiscal policy. Examples, you may be asked. I explained one already when we were talking about growth. We call it what? Expansionary fiscal policy. Expansionary. Expansion means you want to ensure there is growth in the system. Okay? Or another one is contractionary. So that's the direct opposite. It means that you want to contract. You want to restrict the growth. How do you do that? It's direct opposite. So if we are decreasing taxes, increasing expenditure to achieve growth. If you want to achieve a contraction in the growth, you reverse the two. This time you increase the taxes, reduce the expenditure. You will achieve a contraction in growth. You can also talk about discretionary. Discretionary fiscal policy refers to policies that are decided and implemented by one-off policy changes. One-off. So it's just something that is targeted. A policy or a decision, usually a law will back it, to make sure we just change a specific thing. It could be unemployment. There's so much unemployment that we needed to bring some intervention, specific intervention. Those one we call it what? Discretionary fiscal policy. Example, it may be on the lighter side, but you know the problem with NAPCO, it was to address a specific need. All of us have different understanding of whether or not it's achieved that purpose, but the unemployment levels in Ghana is so high, very high. So if government steps in to formulate a particular policy to address a need, which is a one-off change, usually we call it a discretionary fiscal policy. So in an attempt for businesses to do well, government can say, look, at this point in our development, we need to reduce taxes. So let's remove taxes. Let's remove the petroleum taxes. They are just too many. They are just too many. How can we be paying more when the prices have not even gone up on the world market? Yes, and they told us that because your CD is depreciating. Okay, but we have found oil in commercial quantities, and we have an oil refinery. You understand? So how much more can God bless us? You have the oil. You can take the crude oil. You have a refinery. Why should you be paying high prices because your CD is depreciating against the dollar? It is because we don't have a growth mindset. We always want to look for the quick fix. And so the refinery is rusting. People are selling cables. Did you read that 10 million worth of cables were stolen? And because you are not using the facility, you have started stealing cables. And we are paying high in fuel prices because you are not, producing the oil yourself, even though God has given it to you. Let's continue. Okay, so we talk about discretionary policy. The last one is automatic stabilizers. What do we mean by that? That one is not anybody. It's not a deliberate policy. The system is regulating itself. So this thing right now we call fuel prices have gone up. Monday, the GPRT people will announce an increase. So if you do a lot of rounds with your car, now you will be mindful, right? You'll be mindful. If you do a lot of rounds, maybe you are thinking of merging 2-3 rounds in one, so that the number of things you do, that if data cost goes up, people will anytime they go to bed, they will now switch off their data. At first, when it was very cheap, you will forget. Now you will not forget. So the system is regulating itself. The taxes go up, people will cut down on their consumption. Do you understand? So that at least they will be able to manage and live their decent life. So that is the swing. It's a swing in the system. It's not anybody who is formulating a policy. But when taxes go up, people will respond. That response is automatic. Are you with me? Are you with me? The data is what? It's increasing. The cost. Are you not talking too much or brushing too much? The cost is going up. Everything is going up. Sorry. Now let's move on. We've talked about public fiscal policy, and we've discussed the various types of fiscal policy. And then we said that mainly the use of government tax revenue and government expenditure are the two main items under fiscal policy. But if you look at the budget, government budget, even though it is primarily expenditure and revenue, other things have become a very important part of our fiscal life. One of those items is debt management. Debt management. So, how important is the issue of debt management? It is because we have realized we cannot live without borrowing. Our needs are more than we can generate in revenue. In recent times, because of COVID, our ability to even generate the revenue has gone down. Meanwhile, funny enough, we are not able to cut down much on expenses. So our funding requirements have increased. We have to now borrow more. So why is the debate on debt management so important and central to the fiscal policy alternatives? It is because we need to begin to have to start having a conversation on how to stop borrowing so that future generation will not suffer too much. Already we are suffering because we are told more than 50% of our tax revenue goes into servicing debt. So all the big amount the GRA talks about that they have achieved, if it is true, then it is serious. That we are almost about 50-60% goes into servicing of debt, then that's serious. Now, to the extent that we need to borrow to clear existing debt, that is how serious. And it's not 2 years, 3 years, it's 20, 10, 15 years. So your children, when you are sitting in your armchair, tired and weak, they will be facing it. So we need to start having a conversation on how to stop. That is why debt management has become part of fiscal management or fiscal policy alternatives. How do you use debt as an alternative fiscal policy? It is an exam question. Okay, so discuss the use of debt management as an alternative fiscal policy. How? What is it about debt management that is so central to ensuring that we stay within the correct limits of our budget? Our deficit is within control. Our borrowing requirements are within control. Why is it that debt management has become an alternative fiscal policy? How? So it enables governments to invest in critical infrastructure. Now, when we say debt management, it's not just managing the existing debt. It also has something to do with you going for new debt. Debt in itself is not bad. Everybody here seated, at one point in your life or the other, you may need to borrow, which is okay. But what you're using the borrowed funds for is also very important. And if you misplace that priority, you will suffer. You understand? And remember that you always borrow, mostly, to finance a revenue-generating project. You don't borrow to consume. What will generate cash flows for you to pay? So these are some of the problems we have in Africa. You borrow and make sure you put in a project that will generate cash flows later for you to now pay interest and the principal. If you don't do that, you will find yourself in a difficult problem. So why is public debt a good alternative? Is it important for us to borrow? Yes. Why? Number one, it enables the government to invest in critical areas of infrastructure projects and social sectors of the economy where taxation is not possible. You don't just get up and say, I want to put new taxes on the citizens. We don't enjoy paying tax. Because already we believe the tax is too much. The government says that the money is not enough. So government is between whether to raise new taxes or to borrow. Those are the two options all the time. Now we've paid the tax to a point that people are running away from paying taxes. So if you bring more, even the existing you are collecting, you will lose it. Yes. So you don't have any choice. You have to go and borrow. Now there's another animal called a limit to the debt. We call it debt to GDP ratio. So you cannot breach that ratio. If you go past a certain stage and the cost of the debt is so high, so how do you deal with it? The country must run. So at some point, if it's about critical infrastructure, government has to borrow. All these big interchanges and bridges, we can't generate money here because we need the money right now. So it's a good thing to borrow. If the reason or the objective is to make sure we invest in critical infrastructure where tax generating, or levying tax is not a good idea. It makes possible for government to shift taxation from current to the next generation. Maybe because of the current economic situation, government doesn't think that it's proper to impose taxes because now there's COVID. You understand? People have lost their jobs. Businesses are struggling to survive. People have settled for half salary. You don't know that you are blessed. So it means that government may decide that taxing this current generation is not a proper idea. So we should rather go for loans or debt now. The taxes will go later. So another reason or justification for debt is if we don't want to impose tax on the current generation for all the good reasons. The third point is that public debt is a safe way for foreigners to invest in the country's growth by buying government bonds. So if the foreigners buy our bonds, now every month we issue bonds, right? Every month. If they buy our bonds, they are also investing in our growth. All right? And so people don't do FDI. They don't directly invest in countries because they are unable to move capital, manpower to come and set up. So the quickest alternative is to buy government's bond. They know Ghana is peaceful. So they can invest in our growth by buying our bonds rather than coming to directly invest here and set up businesses. It's the safest way for foreigners to also invest in our growth. Excessive taxation, another point, excessive taxation may affect economic activity, which is true. Tax beyond a certain point is counterproductive. Tax beyond a certain point may not achieve growth. In fact, it will even erode the current growth. So those are justifications for the use of public debt. And then another more is that public debt can improve the standard of living of the citizens of a country, especially when the funds are used directly to finance critical economic infrastructure. It's true. If you are in Accra, Cantonment, East Legon, so you don't know. The roads in Ghana are bad. Very bad. Very, very, very bad. So if the monies we are borrowing are doing those jobs, fantastic. Then the country, there will be economic growth. People who are driving, cutting the goods, traders can go to the marketplaces and there's economic activity. All that is good and a good reason for us to go for the loans. However, we should use correct judgment in going for loans because every loan comes with what? Interest. Yes. Government borrows to enter HIPIC. They are all choices. So. They are all choices. We can prevent going to HIPIC by cutting down costs right now. I'm telling you. It depends on leadership. If a leader wants to call the bluff, the next election, it will happen. Are you getting me? It's a matter of cutting certain expenses. If you are struggling to subsidize fuel, a nation that has found oil in commercial quantities, everyday prices of fuel is going up. Can you justify all the government appointees and the ministers and all the agents or whatever are not buying fuel? Can you justify it? Can you imagine the type of cars they are using? And the fact that when they go for functions, they leave the engines on. They don't buy it. The people who take decisions on fuel prices don't buy the fuel. So HIPIC, yes, it's a choice. If you ask me, we shouldn't go to HIPIC. they will put restrictions on us. Free SHS will suffer collapse. Because one of the impositions of the IMF is that you can't tell us that you are struggling to survive, meanwhile you are providing subsidy. They will freeze, employment in the public sector, even though they say they are not taking anybody, but people are going there every day. But then they will freeze employment in the public sector, whether police or army, they will freeze it. Maybe they can negotiate for the security forces, but they will freeze employment. You can't subsidize fuel. You can't subsidize free SHS. A number of restrictions. So you will not be giving loans. Frequently, you'll be giving grants. But those grants come with serious restrictions. And those restrictions will put a hold on your growth. So if we are a serious-minded country, we shouldn't go for that. Yes. Yes, so they will cancel the debt. But if you stay in that thing for 5 years, the question is, will you be able to, but simply canceling your debt, is it enough? It depends. If we find ourselves in a very serious situation, we may choose that, okay, HIPIC is better. They are going to cancel all our debt. Yes. Yeah, that's one option. That's one good example, because it means that your ability to pay debt is very much impaired. You are not able to pay your debt. So your credit rating, while still in HIPIC, is very poor. Already our credit rating is going down. So that is why the cost of borrowing now for us, Ghana, is very high. And it is the more reason why we need to cut down on our expenses and live within our means. All this is part of the fiscal management policies. You understand? We need to live within our means. We should be able to do that. We don't need to set up 125 ministries. For what for? You understand? Anyway, let's move on. Any questions? So, apart from that, you need to also understand how the government agencies get revenue, how government is able to generate revenue. It's part of the fiscal policy decisions. So the decentralized units of government, the district assemblies, the municipal assembly, how do they get money? They get money from what? Receiving direct transfers from government, or what we call internally generated funds. So as part of the measures for money to get to those institutions, we have something we call the District Assembly Common Fund. So I think 2 sittings ago, students were asked to explain the objectives of the District Assembly Common Fund. So you need to understand that there are basically 2 of those funds to ensure there's intergovernmental transfers. Those transfers are, the means through which the other local authorities get funding. You understand? So the district and the municipal assemblies, they get money mainly from the District Assembly Common Fund. And then others are able to also generate their own internal funds through property rates, rentals, and all of that. So the District Assembly Common Fund is a formula-based distribution system. Usually it's 5% of our tax revenue. The government allocates 5% of the tax revenue in the budget to the district assemblies. In recent times, they struggle to send the money because there's no money. Another form of the fund is the District Development Fund, another performance-based grant system. So here, they look at districts that have done better in terms of criteria. So government will set criteria for all the district assemblies, maybe revenue generation. If you're able to collect so much revenue, then you can have a certain additional allocation. All of that. It's all part of intergovernmental transfers. So it's important you understand the local government transfer system as well. Any questions? So what are, examples of questions you are likely to see in this area? Questions like critically examine public debt as an alternative to taxation and its effect on the economy. Identify and explain 5 goals of government spending as a fiscal policy instrument. Describe 5 benefits or 5 causes of deficit financing. 5 benefits of deficit financing. So what's deficit financing in the first place? Say again. Deficit financing. Okay. What does it mean? The what? The losses. Is it losses? Balance of payment. What is deficit? When we say budget deficit, what do we mean? Yes, when expenditure exceeds what? Revenue. Government must look for funding to make sure to make up for the shortage. The funding can come from grants, it can come from loans, it can come from additional taxation. It's all part of the deficit financing. So question is, what are the objectives or the benefits of? Okay, 5 causes. Okay, of course you can talk about a million causes of deficit financing. If you are, yes, we are spending more than we can collect. We are not collecting enough. Taxpayers are running away. They are not fulfilling their tax obligations. You can get 1,001 reasons why we are in the deficit financing situation. If you ask me, we can solve all of them. If Ghana is your business, you can fix it. Yes. Anyway, I don't know what is there that when people get to the throne, all the nice things they say appears to be difficult. Do you realize that? I mean, I'm not talking about, it's not politics. This is not politics. When people finally climb the throne, they see things from a different perspective. So, explain the concept of expansionary and contractionary fiscal policy. These are examples of questions you can get from this side. Any questions?